Buying your first car is more than just a purchase, it's a rite of passage. It represents freedom, responsibility, and, for many young Americans, the first major step into the world of adult finance. However, walking into a dealership without a plan is like walking into a final exam without opening the textbook. To help you navigate this, we've put together a deep dive guide designed to take you from clueless to confident in the time it takes to finish your favorite podcast. 1. The anatomy of a car loan. To truly master your car purchase, you have to look past the shiny paint and understand the anatomy of a loan. For most young Americans, a car loan is the first time you'll deal with amortization, the process of paying off debt over time through regular installments. Think of your loan as a machine with several moving parts. If one part is out of alignment, the whole machine becomes much more expensive to run. 1. The principal, the core. The principal is the meat of the loan. It is the actual amount of money you are borrowing to cover the car's price. Calculation: vehicle price plus taxes plus fees. Down payment plus trade-in value equals principal. The goal: keep this as low as possible. Every dollar added to the principal doesn't just increase your debt, it increases the amount of interest you pay over the life of the loan. 2. The APR, the cost of money. The annual percentage rate APR is more than just an interest rate. It includes the interest plus any prepaid finance charges or lender fees. Fixed versus variable. Most car loans in 2026 are fixed rate, meaning your interest stays the same even if the economy changes. Simple interest. Most auto loans use simple interest, meaning interest is calculated daily based on your remaining principal. Winning strategy. Because of simple interest, paying an extra $50 a month toward your principal can shave months off your loan and save you hundreds in interest. Winning strategy. Because of simple interest, paying an extra $50 a month toward your principal can shave months off your loan and save you hundreds in interest. 3. The loan term, the timeline. This is how long you have to pay the money back. In 2026, the average loan term for young buyers has crept up to 72 months, 6 years. The trap: a longer term makes the monthly payment look affordable, but it keeps you in debt longer. The upside down risk: cars lose value, depreciate quickly. If you take a 72 or 84-month loan, you might owe $15,000 on a car that is only worth $10,000 3 years from now. This is called being negative equity for taxes, fees, and the back end. When you see a car listed for $20,000, that is rarely what you actually pay. The anatomy includes several hidden attachments. Sales tax, usually 5% to 9% depending on your state. Documentation fee, doc fee. The dealers charge for processing paperwork. This can range from $100 to $800. Add-ons. This includes things like extended warranties, gap insurance, or nitrogen-filled tires. Warning: if you finance these, you are paying interest on them for 5 years. 5. Amortization. How your payment is split. When you make a $500 monthly payment, it doesn't all go to the car. The bank first takes the interest, their profit. Whatever is left goes to the principal, your ownership. In the first year of your loan, a huge chunk of your payment goes to interest. As the principal gets smaller, the interest portion shrinks, and you start owning the car faster toward the end of the loan. 2. Credit scores. The grade that costs you money. In the US, your credit score is the primary factor in determining your APR. For young viewers, this is often the biggest hurdle because you haven't had time to build a thick credit file. In the world of adulting, your credit score is the closest thing to a permanent record you will ever have. For young Americans in 2026, it isn't just a number, it's a financial power level that determines whether you drive a reliable car with a low payment or a clunker with an interest rate that feels like a scam. Here is a deep dive into the mechanics of credit scores and how they dictate your car buying journey. 1. What makes the number? The secret sauce. The most common score used by lenders is the FICO score. It ranges from 300 to 850. Lenders use this to predict one thing: how likely are you to stop paying your bills? To master your score, you have to understand the 5 ingredients. 35% payment history. This is the heavyweight. One late payment 30+ days can take a high score by 100 points instantly. 30% amounts owed utilization. If you have a credit card with a $1,000 limit and you've spent $900, your score will drop. Banks want to see you using less than 30% of your limit. 15% length of credit history. This is the time factor. This is why young people often have lower scores. You simply haven't been in the game long enough. 10% credit mix. Do you only have a credit card? Or do you have a mix of a card, a student loan, and maybe a small personal loan? Banks like variety. 10% new credit. Every time you apply for a loan, a hard inquiry, your score takes a tiny 5-point hit. Don't apply for 10 cards at once. 2. The interest gap. A tale of two buyers. To see why credit matters, let's look at 2 22-year-olds buying the same $25,000 car with a 5-year 60-month loan in 2026. The brutal reality: B pays $7,860 more for the exact same car just because of their credit score. That's enough money for a high-end gaming PC, a European vacation, and a year's worth of gas gone just to pay the bank. 3. The thin file problem and how to fix it. Many young viewers don't have bad credit. They have no credit. This is called a thin file. If a lender can't see your history, they treat you like a risk. How to build credit from scratch in 2026. The secured credit card. You give a bank $300 as a deposit, and they give you a card with a $300 limit. Use it for 1 tank of gas a month. Pay it off instantly and watch your score climb. Become an authorized user. If your parents have great credit, they can add you to their oldest credit card account. You don't even need to use the card. Their years of good history will teleport onto your credit report. Experian Boost Rent Reporting. In 2026, you can get credit for things that didn't used to count. Apps can now report your rent payments, Netflix subscription, and utility bills to the credit bureaus to give your score an instant lift. 4. How to protect your score while shopping. When you go to a dealership, they will often shop your rate by sending your info to 10 different banks. This sounds scary. Will 10 hard inquiries ruin your score? The rate shopping window. FICO models are smart. If you are shopping for a car, all inquiries made within a 14 to 45 day window count as one single inquiry. The system knows you aren't trying to get 10 cars. You're just looking for one good deal. Warning: do not buy a car and then immediately apply for a new iPhone or a credit card the next week. Space out your big financial moves. 5. Summary. Your credit checklist. Download a free tracker like Credit Karma or your bank's app to see your score today. Keep your utilization low. If your card limit is $500, never let the balance stay above $150. Never ever miss a payment. Set every bill to auto-pay for the minimum amount at the very least. 3. The total cost trap. The biggest mistake young buyers make is focusing only on the monthly payment. If a dealer asks, "What monthly payment are you looking for?" do not answer. They can make up for $100 payment happen by stretching a loan to 84 months, making you upside down owing more than the car is worth for years. Instead, focus on the out-the-door OTD price, the hidden costs of ownership. Your monthly budget must include more than just the loan. In 2026, expect these monthly averages. Insurance. Being young means higher premiums. Budget $150, $300 month. Fuel charging, depending on your commute. Budget $100 to $100 month. Maintenance. Set aside $50 month for all changes. Tires and no fund. When you're shopping for a car, the dealer wants you to focus on one thing: the monthly payment. They know that if they can get that number to fit your budget, say $450 a month, you'll likely sign the papers. But this is the total cost trap. By focusing only on the loan payment, you're looking at less than 60% of the actual cost of owning that car. In 2026, the hidden expenses of car ownership are rising faster than inflation, often costing young Americans an additional $500 to $900 per month beyond the loan. 1. The second loan, car insurance. For young viewers ages 18 to 25, Insurance is often as expensive as the car payment itself. In 2026, the national average for full coverage for an 18-year-old is roughly $500–$600 per month. The trap: you buy a $25,000 sports sedan thinking you can afford the $450 loan. You call for insurance after buying it, only to find out the premium is $400. Suddenly, your affordable car costs $850 a month before you've even bought a gallon of gas. The fix: always get an insurance quote before you sign the car papers. Use the VIN vehicle identification number to get an exact price. 2. Depreciation, the invisible leak. Depreciation is the most expensive part of owning a car. But because you don't pay it every month, most people ignore it. The reality: a brand new car in 2026 loses about 10% to 20% of its value the moment you drive it off the lot. By year 5, it has typically lost 60% of its value. The trap: if you put $0 down and take an 84-month loan, the car's value will drop faster than your loan balance. You become upside down negative equity. If you want to sell the car in 3 years, you might owe the bank $5,000 more than the car is worth. 3. The service station drain. Ownership involves constant microtransactions that add up to a massive yearly total. Fuel charging. In 2026, with fluctuating energy costs, the average driver spends $150 to $150 a month on gas or electricity. Maintenance and tires. Don't forget all changes. $70 plus for synthetic, tire rotations, and eventually, a new set of tires $800, $1,000 to $100. Taxes and registration. Depending on your state, you might pay an annual ad valorem tax or registration fee. In some states, this can be $300, $700 a year just for the sticker on your plate. 4. How to escape the trap. To stay financially healthy, use the 10% rule. Your total car expenses, loan plus insurance plus fuel, should not exceed 10% to 15% of your take-home pay. Use the 3-year sweet spot. Buy a car that is 3 years old. The first owner already paid for the steepest part of the depreciation, the 40% drop. But the car is still modern and likely has some warranty left. The pre-save test. Before buying, take the amount of your expected loan payment and put it into a savings account for 3 months. If you can live without that money easily, you're ready. If you struggle, that car is too expensive for your lifestyle. 4. Buying versus leasing. Which is your vibe? When you're choosing between buying and leasing in 2026, you aren't just choosing a payment plan, you're choosing a lifestyle. For young Americans, this is often a choice between building an asset or paying for a service. Think of it like the difference between buying a house and renting a luxury apartment. One builds long-term wealth, the other offers convenience and the latest amenities. 1. Buying financing, the owner vibe. Buying is for the long hauler. If you want to customize your car, drive cross-country without checking the odometer, and eventually stop making monthly payments altogether, this is your path. The big win. Every payment you make is like putting money into a car piggy bank. Eventually, the loan is gone, and you own an asset you can sell or trade in for your next ride. The freedom. Want to take a 3,000-mile road trip? Go for it. Want to add a custom wrap, upgrade the speakers, or change the rims? It's your car, no one can tell you no. The risk. You are responsible for everything. Once the 3-year, 36,000-mile warranty expires, every weird engine noise is your financial problem. Also, your monthly payments will typically be 15% to 30% higher than a lease for the same car. 2. Leasing, the subscriber vibe. Leasing is essentially a long-term rental, usually 3 years. You aren't paying for the whole car. You're just paying for the value the car loses while you drive it. The big win. You get a brand new car with the latest tech. Apple CarPlay 3.0. Advanced AI safety features for a much lower monthly payment. In 2026, a lease might be $450 a month, while a loan for the same car is $650 a month. The convenience. The car is always under warranty. If the transmission blows up, it's the manufacturer's problem, not yours. Many leases in 2026 even include complimentary maintenance. meaning your oil changes and tire rotations are $0. The gilded cage, you are limited on miles, usually 10,000 to 12,000 per year. If you go over, you could be charged 25 cents per mile at the end. That adds up fast. Also, if you scratch the car or spill coffee on the seats, the dealer will charge you excess wear and tear fees when you hand back the keys. The verdict: buying is almost always cheaper in the long run, but leasing is easier on your current monthly cash flow. For which one should you choose? You should buy if you drive more than 15,000 miles a year. You plan to keep the car for at least 6 to 8 years. You have the itch to modify or personalize your vehicle. You want to eventually live a life with zero car payments. You should lease if you are a techie and want the newest safety and entertainment features every 3 years. You have a predictable, short commute. You are in a transitional phase, for example. You might move to a city with great subways in 3 years. You have a tight monthly budget but need a highly reliable, warranted car for work, the lease and trap. If you lease, remember that the dealer will try to roll you into a new lease immediately. This is how people get stuck in a perpetual payment cycle where they pay for a car for 40 years and never actually own one. If you lease, do it with a plan to eventually buy a car when your income is higher. 5. Your step-by-step battle plan. Buying a car is a high-stakes game. The dealership does this 50 times a week. You do it once every few years. To level the playing field, you need a tactical battle plan. Following this 5-step sequence ensures you stay in control of the clock, the money, and the emotions. Phase 1. The digital guardrail 1 to 2 weeks before. Before you even smell a new car's interior, you must set your boundaries. Run your own numbers. Use the 10th of April 20 rule we discussed earlier. If your take-home pay is $4,000 a month, your total car costs, payment plus insurance plus gas, should not exceed $406. Get pre-approved. Visit your local credit union or bank online. A pre-approval letter is essentially a blank check. When you walk into a dealership with a 5.5% rate already in your pocket, they can't try to sell you a 9% rate. The shadow. Quote, call an insurance agent with the model of the car you want. If the insurance quote is $300 a month and you only budgeted $150, you just saved yourself from a massive financial mistake. Phase 2. The search and the ghost test drive. Research the out-the-door OTD. Price. Don't look at the MSRP on the window. Use sites like Kelley Blue Book or TrueCar to see what people in your zip code are actually paying. The no pressure test drive. Go to the dealership on a Monday or Tuesday morning when they are quiet. Tell the salesperson, I am test driving 3 different brands today, and I am not buying anything until Saturday. This kills the what can I do to get you into this car today pressure immediately. Check the tech. In 2026, car tech is vital. Does the wireless CarPlay lag? Is the touchscreen menu intuitive, or will it distract you while driving? Phase 3. The negotiation, the silence strategy. When it's time to talk money, follow these rules. The 1-number focus. Only talk about the OTD out the door. Price. If they ask about your monthly budget, say, I'm not worried about the payment yet. Let's agree on the price of the car first. The power of silence. When the dealer gives you a number, don't speak. Count to 10 in your head. Usually, the salesperson will get uncomfortable and start explaining why the price is high, or offer a small discount to break the tension. Email is your friend. You don't have to negotiate in person. Email 3 different dealerships. I am looking for model trim. Dealer offered me $28,500 OTD. If you can beat that, I will come in today. Let them fight for your business. Phase 4. The F&I gauntlet. The finance and insurance office is where the dealer makes their real profit. They will try to sell you the protection package. The no list. Say no to fabric protection, ion etching, and nitrogen-filled tires. These are almost pure profit for the dealer. The maybe list. If you are putting less than 10% down, ask about gap insurance, but check if your regular insurance company offers it cheaper first. Read before you sign. In 2026, most contracts are digital. Do not let them scroll for you. Read every line item to ensure no dealer prep fees or market adjustments were snuck back in. Phase 5. The Pre-Delivery Inspection PDI. Before you drive away, do a final walk around. Even new cars can have issues from the transport truck. Check the glass and cross. Look for tiny chips in the windshield and scratches on the lower bumpers. The odometer. A new car should have fewer than 50 to 100 miles. If it has 400, it was likely used as a manager's car or a frequent test drive vehicle. Ask for a discount. The second key test. Ensure you have both key fobs. Replacing a modern smart key in 2026 can cost upwards of $400. Your final checklist. Pre-approval letter in hand. Insurance quote verified. OTD price agreed upon via email, text. All add-ons declined. Spare key and owner's manual in the glove box.